Adobe. You know the name, right? They're a software giant and absolute powerhouse. And by pretty much every measure, they are a fantastic, super profitable company. But, and this is a big but, if you look at their stock chart, it's telling a totally different story. A much more concerning one. And that's the puzzle we're going to unpack right now.
So, what's the deal? How can a company be doing so well, but its stock looks, well, so risky? What is actually happening with Adobe? All right, let's get into it.
And this right here, this slide just lays the whole problem out perfectly. On the one hand, you've got a jaw-dropping 28.79% net profit margin. That's a sign of a truly elite business. But then you look at the other side, and the stock is actually down. It's this total disconnect, right? Strong company, weak stock. So let's look at both sides of this, starting with why Adobe the business is so strong.
Okay, first, let's build the case for Adobe. We're talking about why the company itself, from a purely financial standpoint, is an absolute beast. And let me tell you, the fundamental numbers are seriously impressive. It really all starts with this number right here, almost 29%. That is Adobe's net profit margin. Now, to put that in simple terms, for every single dollar Adobe makes in sales, nearly 29 cents of it is pure profit. That's just an incredibly high level of profitability. It's a massive green flag. And the good news doesn't stop there. Look at this number. This is the year-over-year growth in Adobe's return on equity. It's up a huge 28.56%. Basically, this just measures how good the company is at taking shareholders' money and turning it into more profit. A big growth number like this tells you that management is just getting smarter and more efficient with their cash.
So when the analysis crunches all of this fundamental data, the profits, the efficiency, the whole shebang, it spits out an overall score. And for Adobe, that score is a 6.93. Now the source for this analysis considers that to be way above average, which pretty much confirms it. From the inside out, Adobe is a rock-solid, healthy company.
And it just keeps getting better. The company turns its products into cash really fast. It uses its assets well. I mean, you look at the books and it is just a beautifully well-oiled financial machine. So, the business is great. Case closed, right? Well, not so fast. Because here's the but, and it's a really big one. The story the stock chart is telling is the complete opposite of what we just saw. So let's flip over to the technical side of things and see why the chart itself is flashing some serious warning signs.
Okay, a huge reason for all this concern is a pattern called a bearish engulfing. Let's break that down. Imagine the stock has a good day. The price goes up. A bearish engulfing is when the very next day is so bad that the price drops and completely wipes out all of the previous day's gains, and then some. It's like the sellers just stormed in and took complete control from the buyers. It's a really powerful signal.
And this timeline here shows you just how fast things went south. In late August, the stock was overbought. That's a technical warning that things have gone up too fast and might be due for a fall. Then, bam, on August 28th, that bearish engulfing pattern we just talked about hits. And that just flipped the momentum completely, pushing the stock down so fast that just a few days later, it was considered oversold. This is a textbook picture of a stock losing steam, fast.
So remember that high score the fundamentals got? Well, the technicals get this, a very weak 2.43. I mean, what a contrast, right? And it really highlights the short-term risk the chart is screaming about, no matter how good the actual business is.
Okay, so we've got a great business on one side and a really weak stock chart on the other. To make things even more confusing, let's see what different investors are actually doing with their money.
This is fascinating. What you're seeing here is a real tug-of-war happening in the market. On one side, you have the big money, the huge hedge funds, the big banks, and they're actually selling. But on the other side, smaller retail investors, that's everyday folks like you and me, they're actually buying. So you've got the big institutions heading for the exits while smaller investors are piling in. So what does a tug-of-war like this actually mean? Well, it just screams uncertainty. When the so-called smart money is selling, but the general public is buying, it often leads to a really choppy, volatile period for the stock until one side finally gives up. It's a huge reason to be cautious right now. And what about the Wall Street pros? Well, they're not helping clear things up. A recent rating from a UBS analyst just slapped a neutral rating on the stock. It is literally the professional equivalent of a shrug, like they have no idea if you should be buying or selling right now. So we have strong fundamentals, weak technicals, and investors who can't seem to make up their minds. Let's pull all this conflicting information together and see what the final verdict from the analysis is.
I mean,
Here it is. The entire conflict is summed up perfectly in this one little table. You have an incredibly strong fundamental score of 6.93 sitting right next to a very, very weak technical score of 2.43. Two completely different stories.
And this brings us to the key takeaway. In the short term, market trends and momentum, that's the technical stuff, they often win the fight. And right now, even though Adobe is a fantastic company, that trend is pointing down. And that suggests the stock could have further to fall. So, based on everything we've seen, the recommendation is really all about patience. The analysis suggests being cautious right now, waiting for these negative chart patterns to play out, and then maybe looking to buy this great company later on, if and when the stock falls to a more attractive price.
Which leaves us with the ultimate question every investor faces in moments like this. When you see a truly great company's stock falling because of short-term market fear, is that a warning sign telling you to run away? Or is that the very definition of a long-term buying opportunity? That's the multi-billion-dollar question to think about.